Morning, Phil. SocGen hosted their Capital Markets Day only a couple of weeks ago, and the message delivered by the new CEO seemed to lead to a bout of underperformance. Your recent focus idea suggests shareholder returns are at risk. Could you maybe take us through some of those risks, please, Phil?
Yeah, good morning. Thanks, Rod. So we've got the new long-awaited for Capital Markets Day came out from SocGen, and two of the new targets really stood out for us. First of all is the revenue growth. Targeting just 0 to 2% growth per annum through 2026. Below the rate of inflation. And secondly is on the profit side. Most banks in Europe have profit goals of 12 to 14%. SocGen came out with a goal of 9 to 10%, so below 10%. That's the lowest of any of the major banks in Europe. So those are two of the reasons behind, I think, the disappointment. But also hidden in there are a few other things as well. One was on the capital ratio side. The bank flagged 135 basis points of hits to their capital ratio. Now, what that basically means is rather than do big dividends or buybacks over the next few years, the bank's going to have to offset those hits they've had to their capital ratio. So hold back that capital to offset those hits. And in addition to that, they had a target for the capital of 13%, higher than what most people expected. And so again, they need to hold back capital to build it up. So therefore, our view is that the dividends and payouts and the buybacks will be disappointing versus current analyst estimates.
And just on that subject of capital, particularly within the investment bank, you mentioned that they'll be looking for capital-light businesses to be involved in. Now, there is a gap in performance between its domestic rival BNP. Is that gap likely to get wider?
I think absolutely it will. And as you mentioned there, the areas of the investment banking markets which have been the most profitable in the last couple of years have been those capital-intensive businesses. It's all on the FICC side, fixed income, currency, and commodities. So if the bank is now saying it can't grow assets in that area and is going to go away from them and deprioritize those markets, it's going to go much more to, say, the equity side and other parts of the investment bank, where it's a bit more sluggish and more weaker areas to be in. Therefore, if they're targeting the slower growth areas, then by definition, they're going to have less growth in those higher markets. So we expect them to actually to continue to lose shares, very much to BNP, its closest rival, but also to a number of its global peers as well.
Okay, then finally, as we look forward, where's maybe some of the key catalysts we should be keeping an eye on?
Yeah, I think first of all is how analysts and the consensus moves on the back of that result. Because obviously you come out with these lower targets, particularly on their revenue growth side, just say that 0 to 2% growth, that's also below it, people's models already. So analysts are going to go back, they're going to see their models, and they're going to revise down their estimates. So you are going to see those numbers coming down over the next few months. And then we go into what happens with the buybacks, what happens with the dividends. Because SocGen had started a buyback program this year, and will they do any more next year? It's still waiting to be seen. Now, say in those consensus models, analysts have dividends going up by 12% next year and by over 20% in 2025 and 2026. For us, those numbers look far too high, given what we said earlier about those capital hits. So we think those dividend payouts and buybacks will be lower than what they're expecting.
Phil, thanks very much for your time. We'll keep an eye on its progress.
Thanks.
Thank you.